Now, this isn't something that we usually lead off with at client meetings, but it does seem to be something that's coming up more and more these days. And with good reason. If at the beginning of 2016, I had said to you that the UK was going to vote to leave the EU, that Donald Trump was going to be the next president of the United States, and that the next president of France was going to come from a party that at that point did not even yet exist, I think you could have gotten some pretty long odds in Vegas. And so all of these sort of surprising electoral outcomes have really pushed this to the forefront of investors' minds. So this information is from Allianz Global Investors. This is their annual Risk Monitor survey of 755 institutional investors. So foundations, endowments, pension funds, insurance companies, individuals just like yourselves, asking investors to highlight their highest concerns for the year ahead. And as you can see here, geopolitical risks and US politics are two of the 5 most commonly cited issues by institutional investors just like yourselves. And this is pretty unusual. Usually you see up here sort of your typical, more economic and market-related concerns. So what we're going to do here this morning is we're going to spend a little time recapping some of the surprises we've seen over the last 18 months or so. We're going to take a look at how those markets reacted. Did they react as we would have expected them to, given the outcomes? See if we've learned anything, and then we're going to peer into our crystal ball and look ahead to what we see coming up in 2018. So we'll take these things in chronological order, and we'll start with Brexit, which was on June 23rd of 2016. Now, as many of you may remember, the polls leading up to the Brexit vote were really close, neck and neck, sort of between Leave and Remain. But what was interesting was the prediction markets were far more confident. The prediction markets, predicted with a fairly high degree of probability that Britain would ultimately stay in the EU. Now, in retrospect, this may seem pretty surprising, but it's important to remember that at the time, the case for Remain, staying in the EU, was actually a pretty good one. Access to the EU market was incredibly important for Britain's economy. Access to the EU was also very important for making sure that London really remained the financial heart, the center of all of Europe. And then labor market flexibility. There are tens of thousands of EU citizens living and working in Britain, tens of thousands of British citizens living and working in the EU, and so maintaining that labor market flexibility and keeping them in the EU was obviously very important. And so as a result, most major economists predicted that if there was a Brexit, that would lead to a recession in the UK, or at the very least a slowdown in economic growth. That would obviously lead to job losses and lower wage growth. All of this seemed like things that were unlikely to be supported by the British electorate. But of course, as we all know, Britain did vote to leave the EU, and I think the market outcome was somewhat surprising. So I'll start with what was about it as expected. So what you see here in the gray is the performance of the British pound versus the US dollar. Not too surprising with the Brexit vote, increased fears of a recession. You saw the Bank of England then come out and begin cutting interest rates. All of this put some pressure on the British pound versus both the euro and the dollar. So not too surprising to see a sell-off there. But what was surprising, what I think very few people predicted, was the strong outperformance of the British equity market. So what we're showing you there in blue is the FTSE 100. That's the major key index for British equities. And you can see after a little bit of initial volatility, the equity markets really took off to the races. The view was that we were going to have a soft Brexit, not a hard Brexit. And lower interest rates was very supportive of the economy, and particularly the stock market. So something that was not to be as expected. Maybe even more surprising than that was the performance of financials. So what we're showing you here in red is the MSCI EU Financials Index. You can see that the largest country weight there, almost a third of the index, is made up of UK financial services firms. And while you did see some initial sell-off in that index, down about 15% in the wake of the Brexit vote, the market then went on to rally about 35% from the bottom during the remainder of 2016. Again, something that I think was pretty counterintuitive versus what we would have expected had we known what the outcome of the vote was going to be. So let's fast forward about 4 months to talk a little about the US elections. So obviously the odds makers in the prediction markets had a little bit of egg on their face from the Brexit decision, but this time they were going to get it right. It was very clear that Hillary was going to win the White House. Her lead in the polls was fairly small, but it was pretty consistent over time. And so this seemed like a pretty obvious outcome. In fact, it was so obvious that I was foolish enough to stand up here last year and talk to you about this very subject. We talked a little bit about the performance of equity markets during election years, when Democrats were in office, when Republicans were in office, and I made 2 predictions. The first prediction I made was we thought Hillary was going to win the presidency. The second prediction I made was if Donald Trump did win the election, you'd likely see some volatility in the equity markets and probably at least a short-term sell-off. So I think the lesson here is beware of any analyst making a prediction, even if those analysts work at Marquette Associates. So while I obviously got the Hillary prediction wrong, I was actually right about the Trump prediction. But I'll forgive all of you if you don't remember it, because you were probably asleep. So what we show you here is the performance for the S&P 500 futures. Now, the futures market trades 24 hours a day, so around the clock. And what we've done for you is we've boxed the performance of the futures during the day of the election. And so what you can see here is very late in the night on Tuesday, when it became clear that Donald Trump was going to win, you did see some initial sell-off in the futures market. They dropped about 5.5% peak to trough. But it did continue to rally throughout the night. By the time we all got to work Wednesday morning, the markets opened up only down about 1% and closed flat on the day. So the volatility we saw was extremely, extremely short-lived. Now, why was that? Well, it didn't take Wall Street long to start talking about and pricing into the markets what became known as the Trump trade. So Donald Trump ran on a few key policies as it applied to economics, cutting corporate taxes, renegotiation of trade agreements, particularly NAFTA, increased infrastructure spending, and reduced regulations. And so Wall Street quickly began pricing this through sort of the economic impact and ultimately the market impact. So we saw higher interest rates on the view that higher deficits would lead to faster GDP growth, but higher deficit spending. We saw a stronger dollar on the prospect for renegotiation of trade agreements. We saw a rally in small caps on the hopes for corporate tax reform. And then financials did relatively well on the hopes of lower regulation. And so what we've done for you is we've charted each one of these sectors and their relative performance versus the S&P 500. So outperforming or underperforming the broader market. And as you can see here, financials did particularly well in the wake of the election as interest rates jumped and there was hopes of a Frank Dodd repeal. Industrial did very well on the back of the expectations of infrastructure spending. Small caps rallied. If you look across corporate America, small caps pay on average some of the highest corporate tax rates, so they were likely to be some of the largest beneficiaries of corporate tax reform. And actually, the one sector that was not expected to do particularly well was technology, and that's really for two key reasons. One is technology is very dependent on immigration for programmers from all over the world, the Googles and the Facebooks of the world. And then also, tech firms have some of the lowest average corporate tax rates. A lot of their earnings already come from overseas. Those are taxed at a much lower rate, and so they were not viewed to get quite the same benefit that you would have seen from small cap stocks. So we put all of this together for you in what we called our equally weighted Trump composite. And what you can see here is the market sort of fully priced in the Trump election by December 9th, 2016. So in a month, we had fully priced in all the excitement about what was going to go on with a new regime and a new policy in the White House. And then what you can see is slowly but surely, over the next 6 months, all of that was unwound. So as we moved into 2017, it became increasingly clear that it was going to be difficult to get all of these policies passed. You saw the market completely unwind all of the excitement around the Trump election. So now let's move forward a couple more months, look at 2017, the French election. The first round of the French election was on April 23rd, 2017. Now, for those of you who, like me, who don't speak French, the rhetorical question we're asking here is, who is this guy? This handsome gentleman to your right is Emmanuel Macron. He is currently the president of France. But just to give you a sense of how unlikely that is, he doesn't turn 40 until the end of this year. Before becoming president, he had never held an elected position in the French government. In fact, he'd never actually even run for political office. As we all know, the French love the British and they love investment bankers. This job he had before becoming president of France was as an investment banker for Rothschild, a British financial services firm. And then most amazing at all, the party that he now leads, that is really the governing party of France today, wasn't even, basically he formed it about 12 months before the actual election. So pretty surprising. And if we look just 10 weeks before that election, you can see here he was still in third place. But he ran on sort of a pro-EU, pro-globalist, upbeat message. That message slowly but surely gained traction with the French electorate. And after the results of the first round election, it became very apparent that he was going to win the presidency. And so the market reaction was very positive. People liked this. You immediately saw the French equity markets jump up. That's what we show you there in red. The CAC 40 is the French equity index. We saw strong performance there. And the other thing we saw was a rally in French bonds. So his main competitor was Marine Le Pen. One of her key policy initiatives was to remove France from the EU. And so you saw some risk premium begin to get priced into French bonds leading up to the election. With Macron's pro-EU stance, you saw that risk premium begin to decrease with higher bond prices and lower yields. But just like we saw in the US, there was a lot of initial euphoria, and then it slowly but surely began to unwind as it became clear that it was going to be difficult to implement all of Macron's policies. So what you can see here is the French equity markets basically peaked the day before the second round. Macron goes on to win, and then as it's become increasingly obvious that not everything is going to happen overnight, we've seen French equity markets basically give up all of the relative gains that they had. So what lessons have we learned? Politics can be just as difficult to forecast as equity markets or interest rates. Even if you can predict them, the market outcomes can be pretty surprising, oftentimes even counterintuitive. And then we need to think about our role as institutional investors with a long-term time frame. As we can see here, markets react very quickly, oftentimes more quickly than we as institutional investors can take advantage of the changes. And so we should be wary of making too many investment decisions based on political outcomes. And actually, it's even a little bit more challenging than that, because even though we'd like to think it doesn't, our political bias comes into play. So this is from a landmark study done in 2012 of individual investors, and it looked at their ability or willingness to take risk based on which political party was in power. And what you can see is for investors, when it's their chosen political party, so if you're a Republican and Republicans in the White House, you typically are more willing to take risk than otherwise. And you've seen that by holding higher beta stocks, more small cap stocks, more value stocks. Now you may say, wait, hold on, that's individuals. We're all professional institutional investors. This doesn't apply to us. Well, actually, there was a follow-up study to this done in 2014 looking at portfolio managers. So in some ways, the most institutional of institutional investors. And it showed many of the same biases were present with them as well. And then maybe most importantly at all, this is from a JP Morgan study looking at longer-term data going all the way back to 1985, so over 30 years of data. And what we can see is politics aren't a strong predictor of market performance. So when GDP growth is above average, not too surprisingly, markets actually do tend to do well. But when you look at increased policy uncertainty or increased geopolitical risk, it has a relatively small effect on which way markets are going. It is not a good tell to see whether markets are going to be strong or weak. So as we look to the year ahead, what do we see on the horizon? Well, first and foremost, in February of 2018, Janet Yellen, the chair of the Federal Reserve, her term is up. So at some time between now and then, Trump will either need to renominate her for another term, or he'll need to choose a successor. So that's certainly something that the markets will be watching pretty closely. And then as we stand here a year from today, the midterm elections will be right around the corner from us, and I'm sure that's something that we'll all be talking about quite a bit. But hopefully we've learned two things this morning. The first one is I will not be making any predictions about the outcome of that election. And secondly, hopefully none of you will be making too many portfolio decisions based on which way the political winds are blowing.